In 2024, the U.S. stock market has crashed more than a dozen times. Some drops wiped out fortunes in days. Others destroyed entire industries. Yet, in the middle of this chaos, a single investor turned a $20 million fund into more than $14 billion. That man was Peter Lynch, and his strategy wasn't built on luck, secret algorithms, or insider access. It was built on simple ideas that most investors ignore until it's too late. Today, as warnings of a global recession grow louder, as interest rates hit their highest levels in decades, and as geopolitical tensions shake global markets, the world is once again asking, what do we do before the next crash? And what would Peter Lynch do now? This is the story of how to prepare for chaos, guided by the philosophy of one of the greatest investors of all time. A strategy shaped by history's most dramatic crashes, the psychology of fear, and the unstoppable evolution of business itself. The story begins in the early 1980s, when inflation was raging, interest rates were soaring, and investor confidence was at rock bottom. Most people were pulling money out of the market. But Peter Lynch, a young manager at Fidelity, saw something different. He believed that hidden inside the fear were opportunities, not magical shortcuts, but overlooked facts. The idea that ordinary people, using their observations, could outperform the experts. His motto was simple: invest in what you understand. But behind this humble idea was a deeper, more powerful philosophy. Crashes are not interruptions. They are part of the system. And the prepared investor survives them, even thrives because of them. To understand why, we go back to the terrors of past collapses. The 1987 crash, known as Black Monday, when markets fell more than 22% in a single day. The dot-com bubble of 2000, when overvalued tech dreams evaporated. The 2008 financial crisis, triggered by reckless lending and complex derivatives no one fully understood. And more recently, the 2020 pandemic crash, when the global economy shut down overnight. Each one was different, but the emotional pattern, panic, denial, confusion, was exactly the same. Lynch believed that the greatest danger wasn't the crash itself, it was the investor's reaction to it. Fear made people sell great companies at the worst possible time. Greed made them buy hype at exactly the wrong moment. Markets didn't destroy portfolios, people did. Lynch studied crashes like a scientist. He analyzed which companies collapsed and which survived. He noticed that businesses with strong balance sheets, stable cash flow, and real demand could recover faster than the rest. He noticed that consumers, even in recession, still bought groceries, still paid for electricity, still visited pharmacies. And he noticed that innovative companies, the ones truly solving problems, came out stronger after turmoil. What looked like chaos was actually a filtering system. Weak companies were exposed, strong ones adapted, and the greatest ones grew during the darkest days. To prepare for the next market crash, Lynch understood that you needed more than stock picks. You needed a mindset built on patience, discipline, and cold analysis. A mindset that sees beyond the news cycle, beyond the social media noise, beyond the fear. When others panicked, Lynch walked into empty office buildings, visited factory floors, studied inventory levels, and spoke to managers. He looked for signs of resilience. Was this company panicking or planning? Was it cutting corners or strengthening foundations. He watched how management teams reacted under stress because crises reveal what calm markets hide. But the world today is far more complex than the markets Lynch studied in the 1980s. Technology has changed everything. Social platforms accelerate panic faster. Retail trading can move a stock in seconds. AI is rewriting entire industries, and global supply chains can break overnight. To prepare for a modern crash, we must combine Lynch's timeless principles with today's economic realities. We must understand how business trends, technological disruption, geopolitical shifts, and rising global debt shape the risk landscape. Start with technology. Lynch invested in companies he could understand, but today's world is driven by AI, machine learning, robotics, and cloud infrastructure. These aren't niche innovations. They are the backbone of global business. Companies like NVIDIA, Amazon, Microsoft, and Alphabet have become economic pillars, not because of speculation, but because economies now run on digital infrastructure. If a crash comes, these companies may not be immune, but their recovery potential is far stronger. Why? Because demand for AI computing power, automation, and cloud services doesn't vanish during recession. It accelerates. Businesses need efficiency more than ever, and technology provides it. Lynch would look at which companies create real value, not hype, and which ones are essential to the next decade of economic growth. Now consider geopolitics. Lynch invested in a world that was more stable than today's, but the modern economy is shaped by wars, trade conflicts, and resource scarcity. Energy markets are more volatile, supply chains are increasingly fragile, emerging markets are rising as giants. To prepare for the next crash, investors must understand these global dynamics. Oil prices no longer depend solely on supply and demand, but on politics and conflict. Semiconductor manufacturing is concentrated in a few countries, making technology vulnerable to disruption. And the rise of countries like India, Vietnam, and Indonesia create new opportunities that Lynch would have eagerly studied. His philosophy wasn't limited to the U.S. It was about understanding trends early and recognizing which companies, globally, were positioned to lead the future. And then there is consumer behavior. Peter Lynch paid close attention to what ordinary people were buying. Today, those patterns reveal something remarkable. Younger generations are spending more on experiences, subscriptions, and digital goods. The creator economy is booming. Health and wellness have become global priorities. Sustainability is reshaping entire industries. These are not temporary shifts, they are structural. And in a crash, consumer behavior becomes even more predictive. People cut luxury first, but keep essentials. They reduce risk, but still adopt technologies that save time or money. Companies aligned with these trends often bounce back faster. But perhaps the most important lesson from Lynch's philosophy is the power of fundamentals. In every crash, fundamentals become the only truth that matters. Revenue, profitability, debt levels, cash reserves, customer loyalty, innovation pipeline. When markets fall, the illusions disappear. The hype dissolves. Only real businesses survive. Lynch famously said, "Behind every stock is a company." During crises, this quote becomes a lifeline. Before the next crash, investors must ask, does this company produce real value? Can it survive without new funding? Does it have pricing power? Is it adaptable? Is it solving a real problem? Because the companies that can answer yes are the ones that rebound and often become the next generation of market leaders. This principle becomes even more powerful when we look at history's greatest recoveries. After the dot-com crash, Amazon, still unprofitable at the time, was dismissed by analysts. But its fundamentals, strong customer growth, a bold long-term vision, and a business model built on convenience, positioned it perfectly for the digital revolution that followed. After 2008, banks tightened regulations, but companies like Visa and MasterCard soared because digital payments expanded globally. After the pandemic crash, companies enabling remote work, digital entertainment, and cloud computing dominated. In every era, disruptive companies didn't just survive crashes, they transformed them into turning points. If Lynch were investing today, he would dissect these patterns. He would walk through the aisles of a Costco, watching how consumers shift from premium to value. He would observe how electric vehicles reshape transportation, but also analyze the supply chain vulnerabilities in battery production. He would examine pharmaceuticals, understanding their long-term stability but questioning valuations. He would study fintech disruptors, but remain skeptical of companies with no clear path to profitability. His approach wasn't anti-technology, it was anti-confusion. He invested in clarity. And clarity comes from understanding what a company actually does, how it makes money, and how it will continue making money when the world falls apart. But Lynch's true genius wasn't just picking winners, it was surviving downturns without panic. He believed preparation was a form of discipline. Before a crash, he encouraged investors to build a portfolio they could emotionally handle. If you can't sleep when a stock drops 30%, then you don't understand the stock. If you panic when headlines scream recession incoming, then you are overexposed. Preparing for a crash is psychological. It requires knowing your risk tolerance, respecting market cycles, and recognizing that corrections are inevitable. In the boardrooms of powerful companies, preparation takes another form. Executives plan for worst-case scenarios years in advance. They build cash reserves, strengthen supply chains, diversify revenue, automate operations. Companies that prepare aggressively survive. Those that don't collapse quickly. Lynch often visited management teams to look them in the eye and ask tough questions. Are they honest? Are they realistic? Are they adapting? A company's survival depends less on its products and more on its leadership. Crashes reveal leadership quality more brutally than any quarterly report. Today's investors face a new kind of uncertainty, driven by rising global debt, inflation pressures, AI automation, and shifting global alliances. But the core lesson remains unchanged. Crashes are not random tragedies. They are historical cycles, patterns, predictable in their unpredictability. And while no one can time them, anyone can prepare for them. To prepare, you must understand the world not as a series of stock charts, but as a complex ecosystem. Businesses rise and fall based on innovation, management, consumer behavior, financial strength, and global forces. When the next crash arrives, it will not be identical to 2008 or 2000 or 1987. It will be shaped by AI, automation, digital currencies, geopolitical competition, remote working culture, and global interconnectivity. But the core psychology of fear will remain the same. The opportunity hidden inside it will remain the same. And the investors who stay calm, stay informed, and stay disciplined will emerge with clarity while others drown in noise. Peter Lynch didn't promise that investing was easy. He promised it was understandable. The future belongs to investors who prepare before the storm, not during it. Those who study trends, not fads. Those who value fundamentals over speculation. Those who treat crashes not as disasters, but as resets, a purge of weakness followed by an era of new possibilities. As markets grow more volatile, as news cycles accelerate, and as global uncertainty becomes the new normal, Lynch's message echoes louder than ever. Understand what you own. Think long-term. Ignore the noise. Study the companies, not the hype. Prepare before the crash, not after. Because the next market crash is not a question of if, it is a question of when. And the investor who prepares today will be the one who thrives tomorrow. For now, the markets continue to climb, fall, recover, repeat. Investors try to interpret signals. Analysts argue, headlines dramatize, but behind the volatility lies a simple truth. Every crash creates a new world. The question is whether you're prepared to face it and whether you're positioned to seize the opportunities that follow.